Okay, good morning everybody. Welcome to the second day of SVCO. So I know some of you were here yesterday. I hope you really enjoyed it. I know we had some really fantastic speakers, some great sessions and conversations, and I'm sure that's going to continue today. I am just going to do a couple of housekeeping points and then hand over to our keynote this morning. Just to say, if you weren't here yesterday, we've got the whole events team in, so if you do have any questions, queries about anything, the events team are in the polo shirts, or ask kind of one of us as well, we can answer anything. And then just to encourage you as well, if you haven't already, download the app. I know you've all got your lanyards. We have made a couple of changes just to some speakers and some rooms since the lanyard was printed, so the best thing is to download the app. That's fully up to date. And we'll be sending out push notifications about the changes as well. Just one point to note today, that Joe Danucci and Maria Sendra, if you're interested in their session, they're going to be speaking at 11:45 in Seminar Room A now. They were due to speak this afternoon, but it'll now be at 11:45. Other than that, I hope you really enjoy the day, and I'm going to hand over now to Thomas, and then he will introduce our keynote speaker for the morning.
Well, good morning. It's a great pleasure to be here to welcome to our plenary session this morning Anne Glover. I would say Anne Glover is one of the most important women in business in Europe today. And I have my reasons for saying that. She's the founder of Amadeus Capital, and Amadeus Capital has been one of the pioneers of the European venture capital industry. I believe it's one of the oldest firms in the UK and in Europe, and it has been pushing sort of the envelope of venture capital finance in Europe for a long time. Now, there are many things you can say about Anne, so I'm just going to say three. The first thing you have to know about Anne is that she gets it. She understands what's going on. She's incredibly well plugged in, but she also has a deeper understanding, and one of the things that's remarkable about Anne is she's actually a deep engineer. She's a fellow of the Academy of Engineering. Not many venture capitalists have that. And she also understands finance, she understands business, and she understands people. So that's pretty good. The second thing you have to know about Anne is she cares. She really cares. She was the head of the British Venture Capital Association. She is the head of the European Venture Capital Association. She's on the Prime Minister's Council for Science and Engineering. And I've seen her, she deeply cares about this ecosystem and about making the UK and Europe a success on the venture front. And the third thing you have to know about Anne is she's very generous. We invited her, and it was immediately clear that there was absolutely no hole in her schedule. But she just created a hole. So without further ado, I'd like to hand over to Anne. It's great to have you. Thanks so much.
I don't think I've ever had that kind of introduction. Good morning, everyone. I believe Silicon Valley came to Oxford yesterday. In the sense that the sun shone and you had a great time and you were hearing about all these entrepreneurs and how successful it is and how easy it is. So I just flew in from Iceland. So I brought the Icelandic weather with me, and I'm here to tell you about the European ecosystem and how it's moving. It's very exciting, but it's challenging, and it's got some structural problems which we're working on. But I'm here to sort of get you challenged to sort of become part of this ecosystem and help make the UK, Europe, as entrepreneurial as Silicon Valley. So let's start. Let's see. Okay, I am chair of what is called the European Private Equity and Venture Capital Association. In 2014, that industry raised 41.5 billion euros, and it invested 39 billion euros. Private equity and venture capital are sister activities. The private equity guys buy existing companies, venture capital creates new companies. Those look pretty healthy numbers. Also, they look quite stable. it's been a big recovery from the financial crisis. In 2009, it was less than half that. So it's a very cyclical industry. And so the industry as a whole, the industry of which I chair the trade association, is actually feeling pretty good because the numbers are much better. But I want to draw your attention to the pale green, which you can see has been flat. That pale green is trustee venture capital. And trustee venture capital has been investing at about 3 to 4 billion over the last 6 to 8 years, and it has not recovered. And you say, why is that? Why is it not recovered? It's been investing in about, the green line at the top is about 3,000 companies per year across Europe. One thing that people don't realize is that government agendas often focus on SME and SME policy. There are 4.7 million companies in the UK. So of those, there are, 90% SMEs. And policymakers focus on the SME community. Venture is a tiny, tiny proportion of that, 3,000 companies. But they're really important companies because they're the ones that will create the new industries of the future. They're the ones that grow ultimately. And that's why they need to be differentiated from the broader SME agenda. Anyhow, we've been investing at about 3 billion. While in the US, basically things have gone bonkers. The NASDAQ has hit its prior high 15 years later, after 2000. There are many multi-billion-dollar exits. There's a lot of challenge as to whether valuations are a bit frothy. The NASDAQ is being asked all the time, is this a tech bubble again? And in fact, private valuations by venture capital firms are now higher than public valuations. You're hearing about this phenomenon called unicorns. A unicorn is a company that's valued at above $1 billion. And there are more private unicorns than there are public unicorns in the US. So the venture world in the US has really come back. Europe is doing its sturdy best. It has created a number of $100 million exits in the last 10 years. This shows both the M&A and IPO activity. You'll recognize, I think, some of these companies. I hope Zoopla, probably for those of you who might be trying to do property in the UK. But Rocket Internet, listed on the Euronext, no, on Deutsche Börse, for about 8 billion, I think it was. And they are doing digital services across the emerging markets. So Europe has done some 100 million, but it's still not moved the needle. So this is showing the trend over time in terms of what has happened in investment. The pale blue is the number of, the amount of money going into startups. The orange is the amount of money going into late stage, and the lines are the number of companies. There is also a seed line, which you see is pretty flat. So the striking thing about this, and I've been talking about small numbers, and why is that actually seed and early activity is pretty good. It's stable at least. It is the late stage activity that has not come back. And I think Thomas actually is hosting a workshop later on what is now called the scale-up problem. In other words, it's possible to start a business here. In fact, it's possible to start a business very cost efficiently because the access to computing resource through Amazon Web Services, the access to talent, the access to distribution, if you want to, is all global now. So the seed and startup activity is pretty healthy. It's the late stage activity that's not healthy. And I would argue that the reason it's not healthy is that our capital markets have not decided to support tech again. So the entrepreneurs who start companies today in the UK are doing very well. They may build a product, they may be forced to sell out early because they can't get the next stage of finance. So that's been the trend. And you can see the two bubbles, 2000, 2006. One was internet, the other was credit. All these markets interlink. So what's the problem? The problem is the structure of the venture industry. last 6 years, bottom top quartile of fund size with the maximum written across the top. It is shocking that 75% of funds in Europe are less than 82 million euros in size. Now, why is that significant? It's significant because if you're a fund manager, you never put more than 10% of a fund into a company. So that means you've got maximum 8 million euros to go into a company. That's not enough, even in syndication, to build a world-class company. You need to have deeper resources. The second reason it's a problem is that institutional investors, very large investors, need to invest in funds of over 100 million because they want to deploy very significant amounts of capital. In extremis, I went to China to talk to the Chinese Investment Corporation and had a very nice conversation. I was doing this as part of a delegation. And I said, well, are you interested in investing venture capital? He said, how big's your fund? And I said, well, we have 3 funds and they're about $150 million each. They said, our minimum check size is 500 and we won't want to be 100% of your fund. So, and you can get that answer from the Canadian pension funds, you can get that answer from the North American pension funds and from the endowments, the big sovereign wealth funds. So venture capital has difficulty reaching the big pools of capital that take risk and know how to take risk. And particularly in Europe. So we have this very fragmented, small, difficult industry. And the result of that is that in the last 6 years, only 49 funds, so roughly 8 per year. 8 years? Yes, 8 years. No, 6 years, 8 years. 8 funds per year have actually achieved critical mass. And that, when people say, well, we can't get venture capital in Europe, the fund sizes haven't been able to grow to the point that they can actually support the entrepreneurial ecosystem. And this is, it's an interesting debate, which Thomas just talked about, is this caused by government or is it a market problem? Because one of the challenges as a VC manager is that our private equity brethren go across the Atlantic and raise more than 50% of their capital from North American pension funds. They are scale, they can easily talk to them, they can afford the marketing resources. We're just like the entrepreneurial community. We're very small, we have very few resources, and it's very difficult to get money from outside of Europe. And guess what's happened to the money inside Europe? Well, the money inside Europe's buying government debt to sort out the financial crisis, and it's being regulated out of participating in the risk sectors that we are involved in. So pension fund regulation, insurance regulation, banking regulation, all has forced all of those asset classes, those asset managers to sell their venture capital activity. So we have to reinvent ourselves and go find endowments and family offices to support us. And when the private market has pulled back, which is what's happened in the multicolored below, this black line has become a very significant and frankly far too dominant player in the market, and that is government. And government is now 35% of all capital funding to venture in Europe. And it's not just the EU, it's every single country. So every single country is trying to support its own ecosystem, but it's fragmented. And when you look at where it's playing down in the smaller fund areas. The blue is the government, and you can see that that's very dominant in these tiny, tiny funds that you find in regions around universities. Whereas over here, once you get to scale funds, you can get other institutions and you can get this category called fund-of-fund managers, which are a very important part of the ecosystem, breaking down capital from the sovereign wealth funds and actually directing that into venture managers underneath. So this fragmented market is part of the problem. We can debate the causes, and probably at some point could, but it's definitely the structural problem. But entrepreneurs don't pay any attention to what's happening in venture. They just get on with life and build businesses. And what we found, these are 3 funds that we've raised, 98, 2000, 2006. And what this shows is the percentage of serial entrepreneurs we're able to back. So what we're finding is that it's now 25 years ago when I came back, somebody made their first few million, they bought a country house and retired. They might have a Ferrari if they felt particularly youthful. But that's not happening now. They're going around again, 2 and 3 times. And this was one of the big changes that happened in Silicon Valley that made a big difference, is that a serial entrepreneur who had the knowledge, had the skill, had the network, decided it was worth doing it again. So our entrepreneurs are not sitting back and saying, oh, Mr. Venture Capital, you're letting us down. They're just getting on with life, which is great. They, however, do face a challenge. Because of the lack of money, on a relative basis compared to Silicon Valley, the pricing is at about 40% of the level. Now, for any of you who are entrepreneurs here, it's very difficult to raise money here. It's even more difficult to raise it in Silicon Valley, but if you can, you're going to get better pricing, so it might be worth the trip. This just shows you what happens at all the pricing levels. It's classic supply-demand balance of capital. And again, this shows the problem that I'm illustrating, which is the difference between the startup and the scale-up world. The left hand is seed and first rounds, and you can see that this is, I think, a sort of 6-year period. The number of companies supported in the US versus Europe and the amount of money per company at the beginning. Actually, being 50% isn't too bad, really. I mean, we are a bigger economy, but we're not as dominated in tech. What matters tremendously is the amount of money that the entrepreneur receives. And it's getting closer. It's getting a lot closer. But you flip across to Series B and onwards, and you can see the difference. The number of companies that are supported in Europe is much lower, and the amount of money they receive is much lower. So no matter how smart you are, when you get to this stage, you have a challenge. If you're an average European entrepreneur, you're competing against somebody in the US who has much more significant financial resources, and it's finance as a weapon. So this is the problem that we need to solve. And what's happening is that we're solving by Silicon Valley coming here. The orange line is the penetration of Silicon Valley ex-European investors investing in European companies. That line tells you that the European ecosystem at the entrepreneurial level is working. They wouldn't come here if there weren't great opportunities. And we're glad that they come here because we need smart co-investors. But we need to find a way to build our own ecosystem to be peer to that in order to make this, frankly, a more successful long-term environment. So what does it take? Well, it takes capital markets. So this is an interesting correlation. The blue is actually the easier one. What you have is, it's a US analysis. It's very difficult to do this in Europe. This is the height of the NASDAQ, the blue line. And the brown line is venture capital commitments. Now, if markets were smart, the venture capitalists would pile in, or people would pile into the asset cap before the public markets reach their peak. They're not smart. That's why they're cyclical. And what happens is that venture capital commitments peak about a year after the public markets peak. And why is that? Because basically people get the confidence that the public markets are going to end up successfully buying these companies, giving a return, and based on that momentum, venture capital raises money. It's actually not the smartest time to invest, but it is what happens. And so we need the public markets to have some kind of activity and momentum in order to raise the risk attitude in every asset class within the region. And so in the UK, in Europe, capital markets are getting freer. Quantitative easing's pulled off. We're basically back to reasonably stable growth levels. The debt problems that exist are contained, and therefore, finally, people are beginning to pay attention to equity and say, well, I'm actually getting pretty lousy returns on my debt product. I'm going to start looking for equity product that works. And that's boosting the public market environment, and in turn, that will boost the venture market environment. So I think fundraising will improve this year. So in summary, what's Europe got? It's got some $100 million exits. I showed you some of the names. Actually, there have been 24 unicorns in the last 4 years. That is either priced at or exited at $1 billion. That's not, I mean, it's something like, I don't know, in the US, it's probably more like 150, I think, over the same period. But it's the beginning. The startup ecosystem is vibrant. You're hearing about it here in London a lot. Serial entrepreneurs are going round again. Seed and Series A rounds are competitive. You can get similar amounts of money raised here as you can in the US. You can certainly get the talent. There's no worry about that. It's the later stage financings that are challenged. We have a fragmented VC market with subscale funds that cannot support the best companies. So the US VCs are coming across the Atlantic to fill the gap. So part of my work in terms of trying to identify policy answers is to find ways of attracting the private sector back to the market. Now, obviously, it has to be done through performance, but it also needs to be done through targeted policy measures. And that's why I stay involved at the policy level, both through the Chief Scientific Officer here in the UK, but also at the European level, to try and identify those policy measures that will make a difference. And hopefully, the more buoyant public markets will enable the exits to happen and then encourage more risk-taking attitudes among our asset managers, and certainly from outside of Europe. So we've got lots of the elements in place. We still have a few more challenges to address. And at this point, I'd be happy to take questions. Thank you.
Hey, yeah, so given the Series A crunch and the lack of funding in sort of the growth capital stage,
Yep.
do you think if you could raise a $500 million or $1 billion fund, you could make greater returns than you can with a smaller fund? And if so, why aren't more people coming in and filling that gap?
So I think it's Josh Lerner who did the work on returns in the US and demonstrated it's an inverted U-curve. And basically, fund sizes between about 250 and 400 give you the optimal returns. You go above 400, it's pretty hard in venture to make it work because you need to deploy too much capital. So there is a sweet spot, which is pretty unusual in investing, that there's a sweet, normally scale drives everything. So we do need to raise bigger funds, but probably not 500. Probably 300, 400 would be just fine. And why not? It's this pullback of the institutions. They're just not interested. They're actually advised by their asset consultants to stay away from venture capital. So we don't have the money in Europe except in families and endowments. So we have to find other ways of getting it, probably from outside Europe, to be honest. Have I encouraged any of you to start a business here? I don't think so. No, let me tell you the good reasons. I mean, it is actually an amazing talent pool. I mean, we have probably 50 companies in our portfolio, and they all think globally, and they start small, and they do not have problems recruiting talent. And what's more important is they don't have sort of option switch behavior. It's like, am I going to get the better option package from someone down the road? And Silicon Valley it's a very fluid labor market, and people think of that as an asset. It's actually a liability as well. The teams aren't very stable. They switch all the time. So we have a very interesting environment entrepreneurially where you can actually build a team and keep them if you're an entrepreneur, because there aren't that many alternatives. And so they really get very excited about staying with a particular company for a longer period of time. And that makes for better outcomes. Yeah.
Hi, thanks a lot. Could you say something about Silicon Roundabout and like what's being done there, and whether it has any prospect of like rivaling Silicon Valley or being as good?
Yeah, it'll never be the scale of Silicon Valley. It's doing pretty well, actually. The evidence of that is the number of large corporations like Google who've come in and taken space and are using it as a place to talent spot, effectively. So I do think that it's a significant asset that we've developed. It's kind of a typical government situation. It was happening anyway, and the government got behind it and said, oops, look over there, something's happening. And let's support it, which is great. I think the challenge is exactly the one I'm putting forward, which is there's lots of incubators. There's Techstars, there's Level 39, there's a whole series of incubator space. But when and how are we going to get the real scale up to happen from those businesses? And so when you see them, they don't tend to stay in Old Street. They tend to move somewhere else because they need bigger spaces. But I'm optimistic that you've got the seed corn, literally, that will make it work. So it's not a talent issue. It's not a startup issue. It's also happening all around the country. It's not just happening in Silicon Roundabout. It's just the government put a big spotlight on it, and then the media caught hold, and that's why it's become popular. But most of our companies are in Waterloo or Hammersmith or, somewhere else, which is cheaper now. Yeah.
Hello. Well, thanks for coming. That was really interesting. I was wondering if there was also perhaps a difference in attitude towards entrepreneurship in Europe and in the US. Maybe it's a changing attitude. I grew up in France, and I know that a lot of people frown on people who've tried to start companies and failed, whereas when I lived in the US, I felt that was a very positive thing when someone tried to start a company and fail. I think that might be changing a little bit. I know now a lot of people who are starting companies in France, and I see it in the UK, but I was wondering, what you think about that, and also what can be done to improve it.
Yeah, I think it has changed here. I mean, I think there was that problem a while ago, maybe 20 years ago. I think it has changed, and it's changing with the generations. Basically, there used to be a job for life culture, and that doesn't exist at all across Europe, and certainly doesn't exist in the UK. And once that goes, entrepreneurship becomes a very attractive alternative. So sub 40, I would say there's no issue whatsoever. The big problem is that the people who manage money are older than that, and so they have a sort of rather critical attitude towards someone who's failed. But among your peer group and probably 10 years older, I don't think there's an issue at all. And by the way, there are some very, very good angel groups around the UK, in Cambridge, in Edinburgh, in Bristol, in London. And they're full of entrepreneurs who've made money and are supporting the next generation. So there's enough of a silo of people who are supportive that I think it's fine. It will take another probably 20 years to get fully embedded, but I don't think it's a problem.
On that note, I'd like to thank Anglo.
Thank you.